The investment piece can be one of the more daunting areas to tackle for a surviving spouse. I'd say especially if they weren't involved in the financial picture as much. There are a few common themes that we see with surviving spouses around investment planning. Say first is a need to get a view of the big picture, the overall asset allocation across all of the accounts. It's completely understandable to feel unsure about how everything is invested, especially when you're trying to make sense of the full financial picture. In many cases, it's because the surviving spouse may not have been the one managing the day-to-day details of the finances. But in many cases, even when they were involved, the overall plan may not have been clearly laid out or connected in a way that made it easy to see how it all works together. So the first priority is simply consolidating that view, getting clarity on how everything is positioned when we look at all accounts together as one portfolio. And from there, we can see the percentages and amounts that are invested in riskier assets with higher growth potential, how much is in lower risk assets, what's the overarching investment strategy or philosophy across the whole portfolio, these sorts of things. Because without that, it's going to be really hard to make smart decisions going forward. Second is then assessing whether any changes to the investment approach might be needed, especially in light of cash flow or income shifts. So losing a spouse often means that income sources change. Maybe a pension is reduced. Social Security that is being received by the entire household may likely change. And in some cases, the monthly expenses look quite a bit different too. It's not just about income. And so we take a step back and look at how much income needs to come from the portfolio now and whether the current asset allocation still makes sense based on that, whether it can support that. And this is also where we really try to understand the surviving spouse's risk tolerance, both their comfort with risk and their financial ability to take risk in the portfolio based on their goals and time horizon and objectives. I'd say too, sometimes we will hear a widow say they feel guilty making any changes to the portfolio because their spouse was always watching it or managing it the way it's currently positioned. But it's very possible that the investment strategy or philosophy of this portfolio might not be appropriate anymore. And that's a critically important thing to understand and consider. And so I'd say third is evaluating the risks posed by concentrated positions or even too much exposure to specific sectors or industries. In some cases, we'll find that the portfolio is really heavily weighted toward a single stock or a few different stocks. This might be a former employer's company or perhaps a company that has done really well and grown substantially. And while that kind of concentration may have been intentional at one point, or maybe it wasn't sold to avoid tax consequences, it can now pose a greater risk to the long-term plan. If these concentrated holdings are in a taxable account, we'll also look at whether a full or a partial step up in the cost basis occurred or should occur based on the account's titling, because that will open the door to more tax-efficient diversification of these positions. And then finally, I would say planning for the role of large cash balances or life insurance proceeds. So if there is a large new pile of cash that is received, it can feel like there's pressure to do something with the money. But unless there's an urgent need, we usually recommend taking some time to think through what the best use of those dollars might be. For example, we've seen some people rush off to pay a mortgage that might have a very low and favorable interest rate, or invest it immediately, even though there were some high priority expenses that were going to be paid in the coming months. Now, it may very well make sense to invest a portion or maybe even all of that cash, but we just believe it should be done with a thoughtful plan that reflects those updated circumstances, risk profile, and financial needs, and not just be done as a quick reaction from a feeling that something needs to be done. So as you think through all these themes, the most important thing is making sure each part of the investment plan supports and aligns with the overall financial plan, the overall financial goals and objectives, because that's really the entire purpose of the investment portfolio.